want to thank everyone for joining us today. My name is Jared Meyer, and I work on the NinjaTrader Business Development team out of our Denver office. We have a very special event for you today with Mr. Tony Peterson of the Intentional Trader. I do want to mention it is important to understand there are substantial risks in trading commodities futures contracts as well as Forex. You should carefully consider whether such trading is suitable for you, and that will depend on your specific circumstances and financial resources. It is possible to lose all the funds deposited with your broker, and you could even incur losses beyond these amounts. Please inquire at this link I'm going to post in the room, which is ninjatraderecosystem.com/risk disclosure for more information or for a copy of the CFTC full risk disclosure. Also, please do remember that these trading webinars are not a solicitation or recommendation, but simply educational in nature. All right. Some more information for you here. This presentation is brought to you by NinjaTrader LLC, which is the technology company responsible for developing and supporting NinjaTrader trading software. Any brokerage-related questions should be directed to the NinjaTrader brokerage directly at 312-262-1289 or by emailing brokerage.sales@ninjatrader.com. All right, so we are very excited for this unique event in which Tony Peterson of the Intentional Trader discusses how price and momentum act like magnets to each other. Thanks again for your attendance today, and without further ado, it is my pleasure to welcome to the NinjaTrader Ecosystem webinar room, Tony Peterson. Please take it away, Tony.
All right, Jared, thank you. Can everybody hear me okay? Excellent. All right, cool. All right, so we're going to go ahead and get started and talking about actually one of my favorite trading indicators. However, it wasn't one of my favorites to begin with. It was something that was introduced to me while I was a struggling trader. You know, I was out there. I'll tell you a little bit more about myself in just a second. But I was out there doing what a lot of people are doing, out there looking for information. And I had heard one of my gurus at the time that I was paying to be in his trade room was telling us about divergence, and he showed us how it worked. And so I tried using it and figured out, you know, this is not easy. The way to read divergence, there are so many different ways of doing it. I never knew for sure if I had done it right. So a lot of people will drift away from using divergence in their trading because it's really complicated. It's one of those things that you have to spend a lot of time with, and you have to be absolutely sure that you're doing it right. So let's talk about divergence and using divergence in your trading. First of all, just a little about me. I started trading the way most everybody else did. I didn't come from a background in trading or finance. I wasn't a floor trader. I wasn't a trading psychologist. I didn't have any kind of experience in the financial world or trading world. I started the same way almost everybody else does, and that is I got bitten by the trading bug because I was introduced to it by a customer of mine. And it looked really easy. I thought, man, I'm a contractor. I work way too hard for my money. I think this trading thing may just be the ticket out for me, and it looks really easy, and I'm really smart, and I can figure this out in about 6 months and be trading full-time for a living. I don't know if that sounds familiar to any of you, but that was pretty much the path I went down. And I struggled down that path for 7 years, and I lost a lot of money. And I did everything that I could possibly do wrong. Then something really big happened. Now, if you want to ask me about that, we're having an event this Saturday. I'll get you some information on that in just a minute. You can ask me questions at the end of that event about this really big thing that happened. And since then, I've been at this almost a decade now of trading full-time. That's all I do. I have become a trading educator because a lot of people wanted to know, well, how did you turn things around? What did you do? And so we've developed this education program around that. In order to help the people that we were trying to educate, I had to develop certain indicators so that it would be easier for them, and then it turned into a whole trading system. So let's talk a little bit more about this divergence thing. Today is actually going to be part one of a two-part series that we're doing, and we're going to finish it up on Saturday. If you want to hear the second half of this event and you can't make it Saturday, go ahead and register anyway, and we'll send you a recording. But we hope that you can all make it on Saturday. There's a lot more time on Saturdays to answer questions. So I spend as much time as you need on Saturdays when we do these Saturday follow-up events. So this is actually a clickable link here. This link right here, if you click on it, you should be able to go and register, okay? And it's also at the bottom of every slide. It's not a clickable link, but if you want to register, there's the address, all right? So today, today is the first part. Today, we're going to talk to those people that like to know how things work and why they work, okay? And then on Saturday, we're going to take that working thing and we're going to show you how to use it, okay? So it'll be like teaching you how an engine works today. And then on Saturday, we're going to teach you how to drive that car with that engine to get the most out of that engine. All right, so we're talking about divergence. If you don't know what divergence is, here's a definition, okay? When the price of an asset or an indicator, index, or other related asset move in opposite directions when they diverge, okay? So divergence is not a trading term. Divergence means moving away from something, okay? So for us, that means moving away from some other indicator. Such as the relative strength index or some other momentum indicator, okay? So this is what we're talking about in divergence. You know, it can be considered either positive or negative. It can be considered hidden. But what we're looking for is a shift in direction, a shift in momentum between price and something, okay? So this would be a divergent condition. You see how price is setting new lower lows, where the momentum oscillator is setting a higher low. It's very common for price and momentum to be in sync with each other. When they get out of sync, this is when we have a divergent condition, okay? Same thing here. You see we're setting higher highs and lower highs, okay? Now, I get a lot of questions about divergence and what are we looking for? What are we diverging from? Divergence is price must diverge or move away from something. For us, that something is momentum, okay? Or momentum of price over the last X number of bars. Okay, so we measure momentum, and it's very typical when you're trading to put an oscillator at the bottom of your charts, right? And this would be called a momentum oscillator. This particular one is the RSI, or the relative strength index. So when we're looking at the RSI, or relative strength index, you'll notice that we have the trend of the momentum is headed up. Okay, so that means we are having increasing buying momentum and decreasing selling momentum, and then vice versa. As the trend starts to head down, decreasing buying momentum, increasing selling momentum. Okay, very simple to see on an oscillator. All right, and this is what we're doing. Now, there are a number of different types of oscillators to measure momentum. Each one of them uses a different type of, different math, different algorithms for calculating momentum, okay? So up here at the top is a very simple one, and this is actually called the momentum oscillator. And it has a very simple calculation. So we got the closing price of the current bar minus the closing price of X bars ago, okay? So that's a very simple oscillator. That creates a very simple oscillator. Then we get into some of the others, the relative strength index, the CCI. some of the others that are more complex. So we're going to look at, though, the most simple one, and I'm going to show you how that oscillator is calculated, okay? Because it's very important to understand how it's calculated so that we can understand what's happening when price and momentum diverge from each other. Okay, so here's a typical chart. At the bottom of this chart, we have what we're going to build an oscillator, okay? So we're going to use that calculation that we just saw for momentum, and we're going to take the current bar. We're going to call this one here the current bar, and the bar 10 bars ago. Okay. So we're going to take the price, the closing price of 94.40, and the closing price of 94.33. Subtract 94.33 from 94.40. And we're going to get a 0.07. 0.07 is now a point on this oscillator, a single point. Okay? Then we're going to move over to the next set of bars. We're going to check the closing price of each bar. We're going to take 94.36 right here, and we're going to subtract 94.30. With that calculation, we're going to come up with another point on the oscillator. Okay? So let's just continue that on, okay? So we've got 94.52 minus 94.46. We're going to have another point, 0.06, okay? Now we're going to get something else that's a little bit different. Notice how we have a closing price higher than the closing price of this bar. We're going to subtract one from the other, come up with a negative 0.04. And we keep doing this every single bar. When we do that, we end up with points. You connect those points with a line and you have an oscillator. Okay? This is how momentum is figured out. Okay? This is one of the algorithms used. But they're all measuring against the current bar. Okay? So we've got the current bar, and then we're measuring back, and we're doing a calculation on previous bars to determine which way we think momentum is headed. Okay? So divergence is going to occur when the difference in the slope between the swing high, okay, this is a swing high right here, of a price, and the swing high, oh, sorry, this is swing high of price, swing high of momentum, swing high of momentum, swing high of price, okay? Or the swing lows, either way. And we're going to measure those, and if they're not headed in the same direction, then we have a divergence condition. All of this is great, right? There's, by the way, just so you know, and this is just for education purposes, there's a lot of momentum oscillators. There's like 7 that are typically used pretty often. The 3 I like the most are the RSI, the CCI, and the MACD, but all of them have their, their features that make them very useful. So let's simplify this a little bit. Let's make this a little bit more visual, okay? Let's pretend this is a price chart. And yes, it's very simplified, and price charts never look like this, but we're doing this for illustration, okay? So we have these bars, and then we have the momentum oscillator. It's very typical for price and momentum to move together. The magnitude of change over the last X bars is very similar with momentum and price. So when things are running normally, this is what we're going to see. Anywhere along these lines, you can look at them and notice that there is no divergence. They're moving the same way anywhere along that line you choose to look. We're going to be seeing price and momentum moving the same direction. No divergence. So we have no real expectation or anticipation that anything specific is going to happen relative to price and momentum. Okay? Now let's look at it a little bit different. Same price, same momentum, but notice they're no longer in sync with each other. Okay? Notice now that a lot of places we still have divergence. We still have no divergence. But at one point, we now have a divergent condition. This is the key. This is the key when we're looking for. All right. So this was when price and momentum get out of sync with each other. Very important. Now, why is it so hard to use? Well, let's look at this quickly. All right, and a lot of times in trading, we don't have an awful lot of time to study things. But if you look at this chart, you'll notice that price is just kind of dropping down, coming back up, and then over again. The oscillator is doing pretty much the same thing, dropping down, comes over, bends down. Pretty much at a quick glance, it looks like exactly what I just showed you on the first slide, and that is that price and momentum are moving together. A lot of people will miss when it's not moving together. When you have a divergent condition, a lot of people will miss it. You can try to train your eyes to do it. I read a book by Linda Raschke, and she said you pretty much just have to do it over and over and over again until you just see it. You know, it's just one of those things you have to train yourself to see. So I tried that for a while, and I sucked at it. Horrible. So we created an indicator to make it easier, but here's the key right here. When you have a divergent condition, so this is what you guys came here for today. This is the one piece of information. If you leave with nothing else, you need this one piece of information right here to trade divergence. When momentum turns before price, price will typically follow momentum. Okay? So if it's so easy, if it's so powerful, why isn't it used more? When I went hunting for a divergence indicator, this is what I ended up with. This was supposed to make it easier. Okay? The problem is most divergence indicators will print several bars after the divergence occurs. Okay? This was so confusing to me. How can you take advantage of this change, this shift in momentum, if it happens, if you only know about it several bars later, and you get these lines that are drawing backwards on the chart? Okay, so I tried and I tried and I tried. Never really knew if I had done it right. So what I decided to do after I learned more about divergence, I studied it for a long time. I decided to start making it part of what we were doing in our trade room, and I developed an indicator to help us see and understand divergence. Now, these are all the indicators that are traditionally used to help see and understand divergence. This is the indicator I came up with. This is called the flash. This was our first divergence indicator. This indicator, use this right here, prints on the open of the current bar, not 3 bars later, not way down here after you've already missed all of this. So we figured out how to make reading divergent. You know, the instant the bar opens, that you have a divergent condition. And if you have a divergent condition, it's highly likely that price is going to try to catch up with momentum. And if you know that, you've got a tremendous edge. Okay? This after the we used the flash for a couple of years before we used any other momentum oscillators to create our indicator. The MACD also lends itself very well to showing divergence and for price to follow the movement of momentum away from price. Okay, so this is our MACD or our McDiver indicator that tells us same thing. We use the exact same algorithm inside the indicator. All we've done is we've switched out which momentum oscillator we're using. Okay. Now that was so successful. I don't know what happened to the text over here. Something about importing it into this Webinato event, I guess, messed that up. That got so popular and it works so well. We remember those 7 oscillators I showed you that were the best ones. We've included all 7 of them. We've now got an indicator called the Super D that will tell you when any one of the 7 or all of the 7 or any multiples of the 7 are giving us a signal that we have divergence. Sharknadoes, no. This is called Webinato, I don't know. This used to be called Omnovia back in the day. So we've taken this, we've gotten better and better and better at taking this information and finding divergence and making it easy to see. Okay? That is the hardest part about trading with divergence, is making it easy to see and understand. We're coming to it, Kathy. Rockstar is not, we're not to the life of Rockstar yet. I'm still in the past here. We're building towards Rockstar. Everybody loves Rockstar. I get so many emails about Rockstar now, and the funny thing is I didn't even think it was necessary because we had these other divergence indicators. But we'll talk about Rockstar a little bit more in a few minutes, and we'll talk about it a lot more on Saturday. Okay? So trading divergence. So a lot of people like, okay, well, if divergence is all that good, then all I need to do is see when divergence is happening, and I'll just throw a trade on. Oh, no, never. Rockstar is like it's like something else. So anyway, no, it's the latest and greatest. So we're looking at these divergent signals, and invariably people come into our trade room and they see these divergent signals, and then they see price do exactly this. Okay, they see a signal like this, and they go, "Oh, I'm going to trade it," because they almost always win. They almost always win. Well, they don't always win. They almost always win. So to just put on a trade, you're taking a big risk, because there are times in the market where divergence happens a lot. During chop, when there's nothing really driving the markets, there's no power in the markets, there's no volatility, there's hardly anybody trading, or if they are, they're keeping it in a real tight range. Price and momentum will be like 2 rivers that are just drifting around. Okay? Under those conditions, we'll get a lot of divergence. And you need to know the difference. Just because we have divergence doesn't mean that it's a great signal to trade. So we're going to have to find the right conditions that makes divergence so powerful. Okay? So what we've done is we've developed a trading system to help us understand the best times to use divergence in our trading. Okay? We use what's called heads-up display indicators. These are non-correlated indicators. So we've got a confluence of conditions right here that tells us that because of this confluence of conditions, we have a real strong chance of price doing something that we can anticipate. Guess what? That's an edge in trading. All you need in trading is to know that something specific is very likely to happen. It doesn't have to be big. You don't have to follow a trend for 50, 100 ticks. All you need to know is that something very specific is going to happen. You know, you've heard people say, if I could just read the future, if I could be 1 second into the future, I could be wealthy beyond imagination. Well, that's the same theory here, okay? We only need an edge, and this is what we have with adding these other indicators, these non-correlated. We call them non-correlated because we get the information from lots of different places. It's not all the same information being read different ways. It's totally different information. So we're going to take the divergence. We're going to combine that with momentum. We're going to use that momentum to anticipate exhaustion. Okay? Go as far as anticipating exhaustion. Go look at any chart and tell me if trends ever move only in one direction all the time. I mean, we all know the answer to that. All trends have strengths and weaknesses inside them. The strengths, by measuring the strength, we can anticipate the weakness. That's where we find our edge. Okay? So we're looking at potential for exhaustion by measuring how hard price is pushing. Okay? We're going to use something called volume spread analysis, or we're going to be reading volume, but only the right kind of volume. We're going to be reading the tape or order flow, okay? And we're going to be looking at relative order flow. These are all trading systems in and of themselves that people use to trade, to try to trade a particular style or system of trading. We actually take them all. We take the best parts of all of them. And when they all come together and all express the same thing, then we have a very strong confluence suggesting that something is about to happen. So let's look at that. Let's look at what a strong confluence looks like. Okay, so on this chart, you'll see that we've got some bars that go from black to a lighter gray. Now, what are we reading here? We're reading that we have some very strong momentum. Relative to what was going on before, we've got some extremely strong momentum. What do we know about strong momentum? What did I just say? It cannot be sustained. It's going to get exhausted. How exhausted? Don't know for sure. But we do know exhaustion is imminent. It has to set in. It will set in. So our mission is to figure out when and then to take advantage of it when it happens. Okay? So we've got a couple of indicators here. We've got our momentum indicator, well, our mometer. That's what we call this, where it colors the bars when we have momentum being generated. And then we have a velocity indicator suggesting that there's a lot of price changing going on inside of that bar. So when that happens, that means that we're getting a lot of potential for exhaustion. Okay, so we want to read strength in order to anticipate weakness. Okay, so what's happening here, this weakness, what is the weakness? It's price moving real far and fast, and it's creating a sudden and unexpected move or an apprehension where people suddenly become fearful, okay? Or they become greedy, right? So either they're getting stopped out by this sudden move, or they're jumping out because they're scared, or they're cashing out because price moved far and fast and they're finding an opportunity. Regardless of why they're getting out of the markets, that's creating this weakness down here, okay? So we have exhaustion setting in. Now, let's find, and so I'm thinking, okay, well, that's pretty good. We should be able to trade that, but let's find other ways of finding and reading exhaustion. You all are familiar with conditions being overbought or oversold, right? So we've got one of our momentum oscillators down here at the bottom, and then we have extremes of the oscillators, you know, the upper and lower limits. When the oscillator exceeds these extremes, we have what's called an overbought or an oversold condition. That is another way for us to see that price is likely to be getting exhausted, and we can anticipate price to want to pull back in between these lines, okay? When that happens, that's when price drops, okay? Cannot be sustained indefinitely. It's going to slow down and reverse at some point, so we want to read strength in order to anticipate weakness. All right, so we have our overbought and an oversold condition. So we're able to anticipate potential exhaustion. If we have potential exhaustion, we know what's likely to happen next. Okay, so let's talk about this volume spread analysis. We're using this for exhaustion confirmation, okay? If you've ever studied volume spread analysis, it can be as confusing and overwhelming as trying to use divergence in your trading, or it was until you've just learned about our divergence indicator. So using volume spread analysis is what we're trying to do is pick up where the market manipulations are happening, okay? And these market manipulators, we call them the smart money. They're doing this to create a typical response from us typical retail traders, okay? That's why they're manipulating the markets, okay? So here's a real simple, easy to understand, overly simplified explanation. But what we do is we're going to measure the volume inside each bar. Now, if you saw this bar and this bar on a trading chart, you would have no idea that, because they look very much the same, I mean, identical on a trading chart, you would make assumptions. Your mind is going to make assumptions about how that chart was, or that bar was built. Fact of the matter is, it could happen any number of ways. One way that it happens gives us no ability to understand that something's likely to happen. So we have what we call a no churn bar. So basically price opens, maybe it dropped a little bit, and then it was just buy, 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 and then it closes up here, and then the next bar opens. Okay, nothing special going on here. Same bar, but very different. Bar opens, maybe drops down here a little bit, goes buy, 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 sell, 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 buy, sell, buy, sell, buy, sell, buy, sell, buy, sell. Okay, very different, right? This is the kind of volume that we're looking for. We're measuring inside every single bar. We're measuring the buying and selling volume. And when we have a positive indication that the buyers are potentially getting exhausted and the sellers who are not exhausted. The sellers have been hanging up here, right? They haven't done anything for a while. They've been waiting for the buyers to get up here. So we know they're strong. They're not exhausted. They're just laying in the grass waiting for us gazelles to come traipsing by. And when we're exhausted, we're easy pickings. All right, so here's an easy example to see and understand here. Say this is a tournament, right? And they're fighting in one night, and this guy's already fought 3 fights this night. This guy's he's been sitting and resting and waiting his turn. Okay, you know that guy on the right is much stronger than the guy on the left, even though the guy on the left might be a better fighter. The guy on the right's fresh. So I'm putting my money on the guy on the right. All right? That's exactly what we're measuring inside these bars. We're measuring for strengths and weaknesses. When we get those types of bars, we're going to print a little dot. If you know anything about volume spread analysis, it can get way more complicated than that. But we removed all of the information that isn't required for making a yes/no trade decision. You're going to notice that all of our indicators, and when we combine them with divergence, all of them give us a yes/no. At the open of every bar, we have a yes/no decision to make. Yes, is it tradable? No, it's not tradable. Okay? Yes, the condition exists. No, the condition does not exist. Okay, we're not looking, we've gone to a lot of trouble to remove these shades of gray that confuse people. This was what was terrible for me. I'd go out trying to learn about trading, and I'd go to webinars, and I'd buy books, and I'd watch videos, and I'd get all of this information. Yes, all of this information is all very good and interesting. And I would try to add it all to my charts because I kept hearing that these famous traders use this, and these very popular traders on these trading forums that seem to know everything use this. And so I need to be using this. I'm missing the boat. And so I just keep adding things together. And what happens is you create these shades of gray where maybe 5 indicators are saying trade and 4 indicators are saying don't trade. And it really suddenly depends on what kind of mood am I in right now? Am I scared? No, I'm not going to trade. Am I bored? Yeah, I'm probably going to throw a trade on. Okay? So I recognize that in myself and decided I've got to remove those shades of gray. Gerald, inside the dots on the pullback alert is different types of price action inside that bar, different types of volume inside that bar. Okay, and I might be talking about that more on Saturday, but I'll definitely, if you ask me on Saturday, I'll definitely give you more information about that. It's a good question. It's really just to identify, make it easier to identify. We use color and a number. It could have been a picture. It could have been anything. We just use the number to help us identify what type of price action is going on inside of that bar. Okay, so tape reading. Tape reading, we all know about tape reading, right? Tape reading was always done because the retail guys want to know what the big boys are doing. Or the big boys want to know what the other big boys are doing. Well, if the big boys nowadays are trading and they're manipulating the markets, you got to ask yourself, why are they doing that? They're not just doing that because they can. They're doing that because they're anticipating on creating a reaction from us, okay? From us retail traders. So today, modern tape reading is the time and sales, right? You can see the orders that are being processed. And if you've ever watched the time and sales and tried to trade off the time and sales, within about 5 minutes, you probably hypnotized and you forgot what you were doing anyway. It's very difficult to use this information visually and use it to know when these manipulations are happening because that's very hard to see and understand. So what I did is I tried that for a while and I decided, well, I can't do that, but I know there's something here. So I was trying to measure blocks of orders going through, and that didn't work very well. But what I did notice is when the orders being processed came through at an extremely fast rate. Didn't have to be a lot of orders. That's where people get messed up. That's where people think that volume is so important. Volume is important. The right volume is more important. Okay? Now, these guys, these market manipulators, can actually manipulate price on relatively low volume, but they move that low volume very quickly. And they can do it now because they own these supercomputers, and they're either next to the exchanges or inside the exchanges, so they have an advantage on being able to manipulate price at their whim, right? And they pay millions or billions of dollars for this opportunity to do that. And a lot of people think, well, that's just unfair for us. Well, to be honest, the more they do it, the better I get at this, because I can understand and read what they're doing. And I can say, hey, if price starts moving at this rate or higher, then it's very likely that price is being manipulated. Okay? So I had a programmer, because I couldn't read the time and sales too fast. So I had a programmer create this histogram for me. And so I noticed when the histogram peaked up above a certain level, price would change directions. Okay? So that was actually a theory that I had, and I thought, well, I'm going to get him to test this out for me and see if it pans out. Probably won't. I'll move on to the next thing. But it was awesome. I suddenly had a picture of where the market makers were likely to be manipulating price. Okay? So I also noticed on that same histogram that maybe the price didn't reach a certain speed, that's called that line like a speedometer. Maybe it just took off real fast like a dragster, a drag racing motorcycle or something. So relative to the previous bars, maybe it took off suddenly. Notice that also caused price to change directions for what seemed to be no particular reason if you just look at a blank chart. But if you have the right tools and you're measuring the right things, all of this suddenly starts to make complete and total sense. Okay? We're getting a big picture view of what's going on in the market. We've developed an area in the market that is largely ignored by most retail traders. And that's where our edge is. So we're looking at momentum, exhaustion. We're using volume spread analysis to read the volume inside every single bar. We're reading the tape, or the speed of orders being processed. We're using divergence to tell when we have these big moves, momentum has already shifted directions. We're using relative order flow all together in a package that when they come together, they are all in agreement with each other. We have an extremely high probability of price doing something that is predictable, and that is an edge. Okay? So, and it's all non-correlated information. Yes, these all kind of overlap a little bit, but they're generally very different. We got price and volume and order flow and momentum, support and resistance. When they all come together and suggest that something is about to happen, we have confluence. When we have confluence, then we have the confidence and consistency to build a trading system from. Okay? So if you look at this, and again, this is pre-Rockstar. I'm going to be showing the Rockstar in just a minute, and a lot more of it on Saturday. We have 10 different indicators right here signaling a potential pullback. Okay? 10. Let's count them. Momentum. That's these bars here, the dark going to light color. If you get into a white bar, if we have a white bar, you can almost bet price is going to turn. Because almost bet, I say almost bet. I know a lot of you guys think you're gambling when you're trading. But this is where you can almost be certain price is going to turn, because we very rarely get all the way to a white bar before price turns. All right? So this is our momentum indicator. So we need a strong push for that. We've got our overbought, oversold indicator. That's this pink outline. So price is overbought. We've got our speed tick indicator, which is based on the time and sales. This right here, this is actually a trigger to identify a trade setup right here. This tells us that the orders being processed are likely to be processed by the big boys, the smart money, because the orders are going through the exchange much faster than us little retail traders have the ability to place trades, because we don't have the money or the computing power to be able to do that. So it has to be manipulated for the orders going through. Okay, so we have the ricochet indicator reading relative order flow. I know it says volume, that's wrong. Our pullback alert indicator, using volume spread analysis to tell us that the buyers were very active until the sellers decided to kick in up here, and then we had a lot of fighting between the buyers and the sellers up in here. All right, that's all of that information is inside that little dot right there. And you know how hard it is to make something that simple? The flash indicator, along with the McDiver, these are two divergence indicators right here. Now, if I was trading this, my trade happens right here on the, where'd my pen go? Oh, there it is. On the open of this bar right here. That's where I place my trade, my short, on the open of that bar, because these printed on the open of that bar. So I had all of this confluence, all of these indicators, and I shorted it right there. Now, we still have more indicators that help us understand that price is likely to be exhausted. We have our velocity indicator, right, that tells us there's a lot of price changing going on inside of that bar. We have our support and resistance lines right here and here, which is a perfect place for price to stop and turn when it's exhausted, when it's come all the way down here and it's gone all the way up here, and then it hits this brick wall. It does not have the strength any longer to get over that brick wall. And also our high of the day is also acting as resistance. All right, now you see how we have this massive confluence of indicators here, suggesting that price is going to drop here. We have a brand new indicator called the Rockstar that is a confluence of these indicators here. The Super D has the Flash and McDiver inside of it. So we actually have this Rockstar, and you could trade with just that if you wanted to. I don't recommend it. I like having all of these other indicators for a heads up that something is likely to be happening. Okay, that you're likely to have, that you can kind of get you ready for a trade setup. But the Rockstar is something that has really changed the trading for a lot of people. And we'll talk about that more on Saturday also. So remember, today we were talking about the engine, right? And divergence, and how we combine divergence with the other things to build a trading system that has a really strong edge. Saturday is when we're going to talk about how to use that edge. Okay? All right, so for all of you here today, we appreciate you coming out. We want to show you our appreciation. We've got a starter bundle that ordinarily goes for $1,095. we're taking $300 off for you guys that are here at the event today. It's going to expire on Wednesday. We do have the agreement with PayPal. They will do a 6 months no payment agreement for our customers if you're approved by PayPal. That includes a lot of the indicators we talked today. And it also includes either a month in our trade room, or if you can't attend our trade room, we'll give you a month of our Fast Forward training program, which will also include in that program will be a video recording of that day's trade room event. So the Fast Forward program is what a lot of our VIPs use to really fine tune and kind of move their trading ahead a lot faster. Let me see if I can put that link in there for you. I'm not sure if I can. Oh, it's not. Oh, there it is. There, Connor got it. Yes, the Rockstar is only for NT8. A lot of the indicators that we showed you today are for NT7 or 8, but we are only developing for NT8 forward from now on, and the Rockstar is a new indicator for us. So we will not be going, and there's some things in it that we just can't do with NT7 that are inside the indicator. NT8 gives us the ability to do a lot more with our indicators. So I finished with about 3 minutes to spare. I can probably take one or two questions, but probably not too many. As I said, yes, it's for sale now. It's for sale now. It's on our website. Very funny.
Hey, Tony, you may probably want to copy that link that Connor posted.
Oh, how do I do that? I've got it in the little chat here.
The link right now.
There it is. Now it got entered. Is that it? Can you see it? Okay. Jim,
yep, you got it.
Bloodhound isn't available for NT8 yet. So it is, we don't have any way to test it on the new Bloodhound. Kim, I can't really talk about individual parameter settings right now. We certainly don't have time for that, but if you can come on Saturday, I can do that. Jim, what we do on a duplicate or multiple indicators is if you buy one, then you get the second one at 75% off for a second one. Does it work with other platforms? No. We only develop for NinjaTrader because it's the best platform out there. We had developed for other platforms in the past, and it was a nightmare. NinjaTrader can do so much more than the other platforms and gives us the ability to develop much more sophisticated indicators. Kathy, certainly the automation is possible, but it would be custom automation. Oh, I'm sorry, Jim. What was the question? Yes, the starter bundle. Yes, everything in the starter bundle can be used in Bloodhound for NinjaTrader 7. You just have to let us know that you're using 7 and not 8, so we make sure we get you the right installation package. We also have some templates for you for Bloodhound to use for our setups. Link for Saturday. Let's see. It's right here at the bottom. I know you want to just click a link. No, the starter bundle does not. But it does, it's not included in the starter bundle. But if you contact us, Connor can probably work out a pretty good deal with you. There's the registration link. Yeah, I tell you what, let's just go ahead and wrap it up. And we'll, let me give you one more. One more link there. You can reach Connor. And if you have any questions about either this bundle or creating your own bundle, we have a lot of indicators. We have a lot of different bundle packages and options and different education tools and things like that. And Connor will be happy to talk to you about all of those. If you have any more questions about them or any more questions for me, let's talk about it on Saturday. We want to thank NinjaTrader for providing us this opportunity. I want to thank you all for coming today. This is one of my favorite parts of doing what I do, getting to talk to you guys and show you what we do. We're very proud of what we do. We're very proud of our traders, and we've been doing it for a really long time. So check in with us. Send Connor an email if you want to come hang out in the trading room with us for a couple of days. Let Connor know, and he'll get you hooked up. All right, Jared, take it away. Thank you very much again. Thank all the guys up there in the head office for letting me do this.
Absolutely. I want to give a special thank you to Tony Peterson of the Intentional Trader for his great presentation today. Everyone in attendance here will receive an on-demand recording of today's event via email, so please keep an eye out for that. The NinjaTrader ecosystem is pleased to sponsor these weekly vendor events as an added service for our clients. So if you find value in these events, we hope to see you again on a regular basis. I'm going to post a link into the room for our other events that we're hosting in the future. We just want to remind everyone the information provided was that of the Intentional Trader and not of NinjaTraders. All information was for educational purposes and should not be construed as trading advice. Again, we appreciate the time you spent with us today. Please enjoy the rest of your day. We hope to see you again in future webinars. Happy trading from all of us here at NinjaTrader Ecosystem.